Hi guys, I'm back again after quite some time talking about the market insights through my short videos. So one thing that we need to understand is that we have been talking about the markets and market theme that which sector can outperform in the year of 2024. So one sector or theme which I believe can outperform in the year of 2024 can be industrial and manufacturing. Though it's not the theme which will be outperforming the market in 2024, only the theme has also outperformed the market with huge returns for investors in 2023 as well. Because industrial and manufacturing is a theme which is being received huge attention by the government of India through various PLI schemes, through the private expenditure, the capex expenditure, the government expenditure. So all types of capex is being focused towards these themes, and the future is to build India as the manufacturing hub and take advantage of the China Plus One strategy. So China was into this phase at least 10 to 15 years down the line, which India has already started from 2022 per se. Where China was 15 to 10 years back, like 10 to 15 years back where China was, India is into this stage now. And that is something which is very crucial for India. So investing and supporting an industrial and manufacturing theme can be really helpful for the year of 2024. And one thing also we need to understand is the small cap and the mid cap gave huge returns in the year of 2023. And nowadays, this has been focused towards investing into the valued mid cap and small cap stocks instead of just putting your money or pouring your money into a straightforward small cap index or a mid cap index. So this thing we need to understand. I completely understand there was a huge rally in 2022 mid to the year of 2023 end in mid cap and small cap stocks. But now it's time to pick up the most valued stock, the stock that can really perform well. And investing into a straightforward small cap index or a mid cap index might not give you returns. It might give you as well, but if we talk about from a fundamentally perspective, it might not always give you the return. So the small cap gave around more than 80% return in 2023 and mid caps gave around more than 60% return in 2023, right? Coming back to the theme of industrial and manufacturing, the one thing that we need to understand is that whenever we talk about the Nifty 50 comprises of the top 50 market capitalized companies, having the highest weightage towards Nifty Financial Services around 33%, around 13% for Nifty IT and 12% for the oil and gas industry. The mixture of this industrial manufacturing companies or theme is very, very minute or small in the Nifty 50 index. But the weightage of this industrial and manufacturing companies is higher in the Nifty mid cap and small cap index, ranging from 15 to 20% even. So that was also one of the reasons that the mid cap and the small cap index rose in 2023. So instead of just blaming the valuation of the index as a whole, it's now time to pick up specific companies which can really outperform the markets in terms of industrial and manufacturing themes. Because there's always a huge possibility that these kinds of fundamentally strong companies from the small cap space can become mid cap in future, or these fundamentally or the strong companies from the mid cap space can become large cap in future. But also a majority of these companies from mid cap can go to small cap, or from small cap can go to micro cap and can demolish your wealth. So that is the reason why I believe that picking up the most fundamentally strong stocks would be most essential. Because picking up the value stocks or a value theme might not be appropriate currently because everything almost is being trading at a higher valuation multiples. That is, everything is being trading at a value above the previous figured value, above the previous 20 days moving average, 20 weeks moving average, or 20 years moving average, right? Or 10 years moving average per se, because everything is being trading at a very high valuation if we compare to the previous averages, correct? So that is something that's going on. But one thing also we need to understand that if a stock is a growth stock, because the previous year was all about the growth story, this year we tend to talk about the value story. But if you're talking about the value story, we need to understand, is there any value stock or theme available? If everything is trading above the price to earning multiple or price to book value multiple, historically high above the previous 5 years average or 10 years average, is that a value pick, or this value pick is just a theme as for now, like just to say or just to blabber about it on various media platforms? I believe if a stock is even above the 10-year fair value or a 10-year average, or a multiple is trading at above even a 10-year or a 15-year average, but that valuation is justified. And how the valuation can be justified? The valuation can be justified if that multiple is being supported by the earnings and growth. Because the price in that multiple, it also gets encapsulated by the various growth assumptions, the earnings assumptions. Because price is a leading indicator. The earnings below is a lagging indicator. Because price is something which is reflected on the basis of the public sentiment. So the higher price to earning multiples, price to book value multiples being higher than the previous 5 years average or 10 years average, but being supported by the earnings, by the growth, the cash flows of the company, if that growth rate is sustainable, if that duration spread, which I've talked about earlier as well, right? Till how much time the company can sustain the ROCE, the return on capital employed over the weighted average cost of capital. So that is the duration spread. If that is much higher and the company can earn a huge potential through its earnings up till a subsequent amount of time, even that high valuation multiple is justified. So I believe this industrial manufacturing theme can do really well. And talking about that everything is a value pick this year might not be fully suffice, because not every stock or sector is being trading at a lower valuation or at a fair valuation. So this thing we need to understand. Apart from that, we have been talking about the EMS space. The electronic manufacturing space can really do well because India is becoming a manufacturing hub, focusing towards the manufacturing, assembling of iPhones, also Geos, and various startup companies are coming up towards manufacturing their own laptops instead of like relying on large multinational corporates like Dell or HP for laptops, or Chinese companies like the companies like Lenovo or something else, right? So India is becoming a manufacturing hub. A China plus one strategy is going on. Also, we can talk about the pharma sector per se, because pharma sector is something which is expected to grow by more than the average growth rate of the country. Indian GDP, or the gross domestic product, which is a mirror image of the growth of the country, is expected to grow by 7.5 to 8% in the fiscal year of 2025, or by around 6.5% to 7% in the fiscal year of 26. So this rate is a very good rate if you try to compare this growth rate of 7 to 8% with the other emerging or developed economies like US. And if we can find a sector which is having a higher growth rate of more than 7 to 8%, that sector is really a good pick. And in the pharma sector, I believe the companies which are into this API manufacturing. API stands for active pharmaceutical ingredient, the raw material for those medicines. Earlier, huge dependence was there upon the imports of these medicines. Not the medicines, but the raw materials, API from China, from South Korea, from US. But now even the Indian companies have started to manufacture these APIs. And instead of these APIs in future, we can become a net exporter instead of a net importer. So all those specific pharma companies which you have to search on your own, which are into towards the manufacturing of API and not just exporting of medicines or producing of medicines, the manufacturing of API, because this industry is expected to grow at an annual CAGR of 14 to 15%, more than the Indian growth rate of 7 to 8%. So this sector can really do good. Talking about banks per se, private sector banks have underperformed. They're still yet to perform, because if the private sector starts to outperform, the Nifty can go from this level to an unprecedented high level. Because people have been quite uncertain about the results of the banking companies, especially the HDFC Bank. So it's not a stock recommendation. It's just a general example, just for information purpose. People have been talking about the lower NIMs, the net interest margin of HDFC Bank. Talking about the higher credit to deposit ratio of 110%, which came down to 105%, quite good in the previous quarter. But one thing also we need to understand, these banks are trading at a very low multiples of price to book value of less than 2. And always take into consideration price to book value for banks and not price to earnings. Because price to book value is a good metric, because the book value will take into consideration the loans for the banks and the provisions set aside. And that's a fair indicator for the banks. If someone is measuring banks on price to earning and talking about price to earning metric for banks, just tell that person to shut up and just don't believe on that metric. Because price to earning might give you a false indicator. It might even be higher or low in a vice versa scenario. But a price to book value might be a very well indicator, because the book value for the banks is the loans which have to be adjusted against the provisions made in terms of some contingencies, right? So private banks can do well on a long-term basis. To a near-term basis, they might not do well, because the current focus upon the banks is to garner deposits. They have to garner deposits because people have been focusing towards the equity markets and pouring their money in the stock markets more, right? So this thing they have been doing, because the markets have been giving them more returns as compared to the fixed deposits or some different safer deposits. So just to garner the deposits, just to garner more and more deposits, they have to increase this fixed deposits, the interest rates on the FDs that they're offering. So that thing they have to increase upon. So that thing have to be taken into consideration, right? So that might result into the compression of this net interest margin. The NIMs might get compressed. And that is quite habitual, because the same thing also happens when in an economy we expect the rate of interest to rise. The rate of interest on loans rise faster as compared to the customer deposits. And similarly, when the interest rates have to go down, the interest rates go down on the loans faster, and that gets priced in the customer deposits later. And as a result, the spread between the rate at which the banks are giving loans and taking loans gets compressed for a short term to near term basis and near term to medium term basis. But in long term, the margin gets back to the normal track. So not to worry about that. The private banks are really good for a longer term basis. And all those kinds of regulations by RBI which are hurting the banks, and the banking stocks are coming down, or the NBFCs are coming down, that might hurt these financial institutions for short term. It might be a kick to them for the short term, but in the long term, the banking and the financial system will become too strong. It's a long term initiative by the RBI, which is being currently seen as negative for banks, being different regulations for risk fades, for AIFs, for NBFCs, gold monetization schemes, various multiple kinds of regulations being coming up by the RBI on Paytm, on Kotak. So these might sound to be, I would say, cumbersome for the banks, but in the future, the financial system will become solid. So banking companies are a long-term play. So that is something which I believe in currently. So that's my view up till this point of time. Thank you so much, guys.